Hey everyone, Rob B here with Rob D, and you are listening to the Property Podcast. This week we're talking about one of the most popular subjects when it comes to property, which is recycling capital. We're going to teach you this week how you can implement this strategy and grow your portfolio at speed.
Welcome to the Property Podcast, where every Thursday morning, without fail, property investors come together to be informed and inspired. Today, we're joined by mortgage broker extraordinaire Dave Cookson. He heads up Charles Louis, who power Property Hub Mortgages, and he's going to be talking us through how we can build our portfolios at a pace that you might not have thought possible. It's not going to be easy though, so after doing all that, you might need a bit of a rest. So stick around to the end for Hub Extra, because we've got a fantastic book recommendation to help you unwind.
So this week's news story, Rob, comes via homesandproperty.co.uk, and it's an interesting headline and an even more interesting story. London's first high-end build-to-rent homes. So these homes are in St John's Wood, very nice area of London, and they're aimed at wealthy finance and tech bosses. Now, the reason why this article caught my eye, Rob, is I thought, wow, let's see what these build-to-rent homes have and features and facilities, because if they're the first high-end ones, they're going to be pretty special. But again, it does seem that headlines can be misleading. Yeah,
this is a creative use of build-to-rent. Normally, when you think build-to-rent, you think a block that's been built for that purpose, where it's got communal facilities, and it's got a specific type of planning for that usage. These are just 5 houses. There's a photo of them. They look like normal houses. They look very nice, but they're just houses. And it says that one of them has been rented to an American investment bank. Don't know what's happened to the others. So, Rob, this actually seems like a complete non-story, but they do look very nice. And for £5,500 a week, I'd expect them to be, really.
Yeah, I'd expect a bit of furniture as well, though, but you don't even get that. So it's built to rent as long as you're happy to sleep on the floor. It's not built to rent. It's just build and then rent them out, which is what I would call buy-to-let, which is kind of what's been around for a long, long time. So, again, it just shows us that headlines are very misleading. And there's not much news in this news story, so I don't know how it's got there. And you could argue why we even featured it. But I think it's really to show that there's just so much nonsense out there. And also to explain to everyone what build to rent is, because it seems Homes and Property don't really know. So if you bump into anybody from Homes and Property, pass the message on. So this week we've got Dave Cookson on. Dave is the brains, the mortgage guru behind Property Hub Mortgages. So what better person to speak to about a strategy that so many of you are interested in, which is recycling capital. Now, recycling capital can be a great way to really build your portfolio with speed. It's not easy to do, but that's why there's a podcast on it, and that's why we're going to take you through this week on what you do have to do, particularly from a finance point of view. You've got to buy at the right price, you've got to get the right property, and you've got to factor in the work. So we're going to cover all of that. So by the end of this episode, you're going to be clued up. If you're already doing this, are you doing it right? Could you be doing it better? And if you're not doing it, is it one to consider?
Dave, thank you for joining us. Great to have you back on the podcast again. So Dave, very common situation. Somebody's got the ambition to own multiple properties, to build up a big portfolio, but they've only actually got the cash to buy one property. Can you help us solve that problem?
Yes, and I enjoy solving this problem because this is a great way to feel like you're earning your crust. We call it recycling money. And what we're essentially looking to do is find some property which we can do that with. That's the hard bit. The easy bit is the financing behind it. This is the model I follow myself. So how do we do it? We have a deposit. Let's use an example. We have a property at £100,000 and we've got 25% deposit. So we've got 25,000, but essentially we buy that, we put our 25% down and we have a 75% LTV. And yes, we're going to start getting rental income and we might have a little bit of savings, which we can save up here and there. But you know, that next property is 2 years away before you can raise another 25,000 and you want more property now. Then we'd be savvy. Okay, so how do we do it? We find a property that's going to be worth £100,000, but is not on the market for £100,000. So essentially what we're looking for is non-habitable property. We might find a property which is worth £50,000, but no one will touch it because it might be fire damaged or flood damaged or you know, it was a probate and it needs a lot of work. They are good properties. So essentially what we do is we could use a product like a bridge to term on there. Okay, so what bridge to term is basically we might bridge that property in at 50,000. We get a surveyor to come and have a look at that property and tell us it's worth 50,000. We then tell that surveyor that we are going to do £25,000 worth of work, and that surveyor will then tell us if it's worth £100,000. We need to have a 25% margin. So we found this property, it's really good. We've bought it on a bridge, it's worth 50,000. We spent 25,000 on it. Okay, we got the bridge and we've used our deposit all up, and all our money's tied up in there, all our legal costs, everything along those lines is £75,000. But we know that the surveyor has told us that if we do all the work we've said we're going to do, that property is going to be worth 100,000. We then refinance and we take that £75,000 back out, and we've got our deposit back. So essentially, we are recycling that pot of money. We can then go again. Ultimately, I think if you were doing one every 3 months, you'd be quite satisfied. The hard part is finding the property. We might be looking for non-habitable, or we might be looking for below market value property. Essentially, if we find something which is below market value, we've got a real good steal, we are probably going to have to wait around 2 years to see an uplift in price. The reason for that is that the surveyor is going to be very cautious to give you an uplift straight away, because they will have seen that you have bought the property at X price, and they want to know why you now think it's worth that. They will be very risk adverse. However, if we buy a property which needs work doing to it, we can justify the increase in the amount of property it is. So recycling your money, it's brilliant. It's absolutely brilliant.
So to be clear then, Dave, if you find a property and you manage to buy it at an absolute bargain just because they need to sell quickly, or you're a fantastic negotiator and nothing needs doing to it, you're going to struggle to get that uplift within a couple of years. But if you're doing some refurbishment to the property to increase the value, that's when you can do something like the bridge to term product, and you can start getting at that straight away.
Correct, yes. I think one thing which I've got to point out as well is the 6-month rule. I know myself and your good self discussed this many times, and we've done it on podcasts and covered it off in articles, etc., etc. But we still get asked the question, you can remortgage your property within 6 months. Okay, it's a lie that you can't do it. So essentially, if we buy a terraced house, we spend 3 months working on it, you can have your money back out. You can then go for your next one. So if we're doing it on a cycle every 3 months, which is what I do myself, you're looking at buying 4 properties a year. Fantastic. You know what that means? That means our rental income is increased. That rental income is now going back into our pot or our limited company and to fund the next deposit. The more properties we have, the quicker we can acquire them.
On that initial purchase then, you're buying the property with bridging finance, you're paying £50,000 for it. How much of a deposit would you need to put down on the bridging finance? Is it the same as the mortgage that you get in the end?
Depends which mortgage product we're going for, but essentially, yes, you can put 25% deposit down on the 50,000. With the bridging product, we can sometimes get you 100% to cover your costs off for building work. So we might have, as I said, £50,000 purchase price. We're going to be putting 25% down on that, but we might need another 20,000 to do it up. Well, we can get you that 100%. It depends what products is most suitable for your needs. The most important part of doing this is finding the property and making sure we have that 25% margin. We don't want to leave any residue of cash in there. We want all that money back out so we can go ahead and buy our next property.
Getting the money for all the works as well sounds brilliant. Is it that easy? Can you really do that?
Yeah, of course you can. Yeah, there are products out there. If we look at the short-term finance market as it stands, there's thousands of lenders there. Oh, maybe thousands is over an exaggeration, but certainly there is a lot more lenders in that market than there is in the traditional buy-to-let market. They are all trying to get one over on each other, and there are products which is 100% building costs. Yes, they may not come cheap, so again, speak to your mortgage advisor, make sure that you are doing your sums, make sure that you understand the short-term finance market, but essentially, yes, we can get you 100% of your building costs.
So Dave, you've said a couple of times that it's finding the property that's the hard part. So how do you go about finding the property?
Good question. This is the most complex part of the whole business of recycling money. I use property sources. If I'm not using property sources, I scour the auctions. That is where we're going to get these properties. They're in an auction for a reason, and that's because they're not selling. So we're looking for these non-habitable properties. But we have to move quick. Scour the internet. Use Rightmove. Look with the estate agents. Speak to the estate agents. Tell them how quickly you want to move on a property. You know, you might get the property before it even goes in the shop window of the estate agents, before it goes on Rightmove. Tell them you're keen. You have got to look everywhere, under every stone, in every nook and cranny. You have to find these properties. There are a million other yous out there who want this property, so you've got to be at the forefront. So set your alerts on the market and Rightmove. Keep on looking. You've got to find it. You've got to be there first, because there are other yous out there and they are ready to take that property from you. So we found the property, we've got the deposit. Do not use all your deposit or all the cash you've got. Leave 10%, 5% for contingency. Things can go wrong. You have done everything you can with this property. You have checked with the surveyor. You've done your price and you've costed your kitchen, but we might take that plaster off that wall and come across a nasty surprise of some sort. Make sure we have a contingency. You do not want to get stuck with a property which you cannot finish off, because essentially that property will be taken off you, and that is not a good thing to happen. So make sure we've got a pot of money. Make sure we've got a reserve to cover any issues which may arise. The lenders, when they are doing your mortgage within 3 months, they want to see evidence, in some cases, that you've done your work. Keep your receipts. Take photos of the build going on. Make sure you've got a factual record. Put dates on these photos. Show that you've done this work. Show that you're good at what you do and you've done it correctly. So keep them, because this is how we show that you have increased the value. Keep the receipts and invoices. Any cost you've laid out, even your own man hours, make sure you've got a record of that, because essentially you are the project manager. In some cases, you may well be getting paid for it. So we need this evidence to show the lender that you have done the job correctly and that you have done what you said you would do.
And you also mentioned the importance of making sure that you really are buying at the price that you need to. Getting your numbers right seems essential here. So what should you be thinking about when you're making the purchase to make sure that you are going to be able to get to that point where you're getting all your money out at the end?
Okay, do your research. So let's put that surveyor's head on. You're looking for property within 3/4 of a mile. Get your comparables, research your area, look at the rental stress calculation. Is it an individual buy-to-let rental stress calculation? Because we're going to be going for a 2-year product, which is going to be higher at the 145%, or is it a limited company one where we're going to get 125%? Then speak to your mortgage advisor, but research the area. If you have the time, look at it. Make sure this is right for you. It is essential. You do not want to leave any money in the property, because that can scupper your next buy.
And is there anything particular that you need to do to justify the value that you're achieving at the end, the amount you've spent on the property, for example?
They're going to be looking for works to be done. If we're going to do this within the 3-month, 6-month period, they want some works to be done. Essentially, what amount of work you have to do depends on which lender we go to. And I think this is obviously a good point as well. Different lenders will lend you on different amounts. So some lenders may well just lend you all the money back that you've spent. Other lenders may lend you more. So you might have got really lucky and you've only spent 20 grand and the property's worth 100,000, then you can take £5,000 out and put it in your pocket as well as the money you've done. Essentially, that's the way we're looking to do it. We find that right property, you've done all your checks, then we're ready to get your finance sorted.
Now, this is obviously a brilliant strategy if you can pull it off. If you can do this 3-4 times a year, you can really be going at a pace, which is fantastic. But as you've already touched on, you can get slowed down significantly if you end up leaving money in the property when you weren't expecting to. So what can go wrong? What risks should you be aware of here and trying to control?
Oh, there are many. That's why research is essential. Speaking from my own experience, I bought a property over in Preston, followed this model, employed the wrong builder. I was told essentially it was going to take 3 months to be done. The whole build took 9 months. Absolute horrendous. It cost me loads because I defaulted on my bridge and I had to service that bridge at around about 15%. Taught me a lesson. Make sure you've got the right builder on site. It is so important. Do your research on them. Don't look at the price. Make sure they're going to give you the service. Don't go for the cheapest one. Ask for references. Have they done this type of thing before? Speak to previous clients. It is essential that you do it. Make sure that you have a survey done on the property. If you're buying from auction purposes, and make sure the survey is done beforehand. If you have to fork out the £250, the £300, whatever it may be, make sure we're having a structural done on that, or certainly a good look at it. I had one client who was a builder, built many houses, had his own building firm, and he bought a property or was going to buy a property from auction. I said to him, get a survey done. He said, I don't need one, I'm a builder. I said, get a survey done. I tell you what, let's get it done. I think we were going to go through BM Solutions. Let's get the survey done from Connells, who service BM Solutions, and then we know it's okay. Well, we sent the survey around, and one of the gable ends was falling down. So if our client had bought that property at auction with his own cash in these circumstances, it would have been a hell of a big job to do and probably a non-mortgageable house. Also, check on your timescales. How quickly do you need to move? Get prepped up. You've spoken to your mortgage advisor. You're sat there. You've told him. You've given him the confidence that you are going to go out and be successful at this. So have a chat to him. Make sure we're looking at speed. Make sure we've got the plan in place. What lender are we going to use for the bridge? Are we going to get 100% development finance? Which lender are we going to exit with? Are we going to exit with Fleet? Are we going to exit with Paragon? How long is that going to take? Communication is key with your mortgage advisor. Essentially, what I will be doing is the day you buy it on a bridge is the day I'm going to put your mortgage application in place. So what happens is when that property is done, I'm waiving that mortgage offer at you. So we're not on that bridge for too long. They are not cheap products. We want you to get in and get off that bridge. So essentially, research, time and communication is what you need to be doing.
Rob, I love that. Some brilliant insights. You covered a lot with Dave. He's certainly got a lot of knowledge. I mean, you can, if you do this, build a portfolio faster. There is more work, and it's, as we said at the beginning, it's not just set and forget. But for some, this is an interesting strategy.
Yeah, if you're in a position where you need to get to a certain level of cash flow quickly and you don't have enough deposits to buy enough property to just do it the normal, easier way, then this is a fantastic option. I mean, if you had infinite cash or you had infinite time, then of course you wouldn't bother because it is a lot of work and there is risk involved. But if you have a target, which is very common, to get to, say, £2,000 a month or something like that, and getting there in 5 years rather than 15 years will make a material difference to your life because it will allow you to leave a job that you don't like and have more flexibility, then that could be effort and risk worth taking on. I think Dave gave a really good flavour of what it involves and didn't shy away from talking about how hard it can be to do and the things that can go wrong. But the big takeaway for me is that the finance aspect for it is actually a lot easier than I thought. And it seems like it's got better in recent years as well. The bridge to term products that he was talking about, where you can agree your onward mortgage with the same lender you do your bridge with at the same time to reduce fees and remove uncertainty, is a fantastic product. And even if you don't do that, in the short-term finance market, there are so many products around now, including ones that will cover the cost of the works that you want to do. So if you can find the right property and negotiate the right price and do all the work that needs to be done, then at least on the financing side, you're very well covered.
Yeah, if you're working with someone who knows what they're doing. Now, this isn't a big pitch for Property Hub mortgages. There are other brokers who know what they're doing. But make sure they understand this strategy and make sure they understand these key concepts and principles. You can use this knowledge, this education, to not test your mortgage broker, or maybe you want to, maybe you do want to test them, but at least have that conversation to see if you do have confidence with them. But if you're unsure, you may want to look elsewhere. And if you want to work with Property Hub mortgages, then fantastic. But either way, you have that knowledge now, which gives you more power to make better decisions. So thank you to everyone who continues to support the podcast. You may do it in different ways. You may leave a review. It may even be an iTunes review. And we get loads of those. Thank you so much. This week's review we're highlighting comes from Steve Hart, 22. Steve says, life-changing. After the recent tax changes, I'd given up on the idea of expanding my portfolio and was focused on just paying down my mortgages on my 2 buy-to-lets. However, after discovering the Property Podcast via Rob's amazing books, my enthusiasm for property has been reinvigorated. The wealth of information and knowledge I've gained over the last 6 months has been immeasurable, and I've since bought a 3-bed flat in Deansgate, Manchester via Property Hub Invest, and I'm remortgaging one of my other properties to buy another one in autumn, and then I'll be able to go full-time into property, which is something I'd always dreamed of doing. I literally can't thank you enough. It's been truly life-changing. Well done to you. You had to take the action, and what incredible action, Rob, to nearly giving up to being full-time in property in such a short space of time by just making better, more informed decisions.
It's amazing. So good to hear. And also an important reminder of something we talk about so often, which is not to get affected by all the nonsense you hear. So many people will read headlines about how buy-to-let is dead and just go, oh, fair enough, it must be. That dream's over, and not think about it anymore. But if you take the time to really dig in and properly work out what's going on, you might find out that actually there's a lot more opportunity than you thought. And imagine how different Steve's life would be if he hadn't done all that. So inspiration there for all of us, and thank you so much for sharing that story with us.
Okay, so we're in the summer holidays, Rob, and let's give everyone a hub extra to help them out. No, it's not suntan lotion. Hopefully you already know the benefits of sunscreen, but actually a audio book, and not a property one. We're going to give you something entertaining, something to sit in the sunshine with and enjoy your well-earned break. And this is an audiobook, Rob, that I passed on to you because I really enjoyed it. It's one of those audiobooks that you go out your way to listen to because it's so gripping at times. And it's called The Spy and the Traitor by Ben McIntyre. It's brilliant.
Yeah, it's an amazing story about a spy during the Cold War and the incredible effect that it had in his own life. And towards the end, it does get so gripping that I was just finding myself going for longer and longer walks just so I could listen to more of it. And also learn so much more about that period of history as well, which I didn't actually know that much more about before. So it's the perfect combination, really, of something that's educational because it's true, but it's super entertaining as well.
Yeah, it's so hard to believe that it's actually a true story because the story is so good and at times almost far-fetched. You can't believe that some of these things actually went on. So check it out. We listened to an audiobook, which was fantastic, but I'm sure it's good in the old written form too. So check it out.
So that's the Property Podcast done for another week. Huge thanks to Dave Cookson for joining us and sharing his knowledge today. Let us know what you thought of this episode. You'll find us on Facebook, Twitter and Instagram at Property Hub UK. We will next see you on Tuesday for Ask Rob and Rob. So until then, have a great week. Bye-bye.
Bye-bye.